We're doing very well on the war front, to put it mildly, I would say. Somebody said, on a scale of 10, where would you rate it? I said about a 15.
I don't see complacency. I think there's a lot of uncertainty around the direction of the conflict, how it'll be resolved, what the off-ramps are.
The president's confidence meets market skepticism as the Iran conflict rages on. Despite today's market rebound, investors are seeking signs of de-escalation that could lift sentiment and ease volatility. Live from Sydney, I'm Paul Allen, and this is Insight, where we dive into the stories that matter with context and analysis. While Asian stocks rebound, the Kospi jumping and the regional benchmark headed for its first gain in 4 sessions. Caution, though, persisting as oil and gold both climb. China sets its least ambitious growth target of more than 3 decades while keeping its record high budget deficit to support the economy. And the US sinking of an Iranian warship off Sri Lanka and very close to India, set to put more pressure on New Delhi's ties with Washington. Macquarie's head of India research and strategy joins us to talk valuations, earnings, and the outlook for foreign investor flows. All right, let's take a look at how markets are shaping up. Much better today than yesterday, particularly the Kospi. We're seeing some huge gains there, up by 10%, and a pretty sharp rebound after the index suffered its worst day ever on Wednesday when it lost 12%. We're seeing similar gains for the index in Thailand. That was hit hard yesterday as well, dropping 5.6%, the most in 6 years. Briefly had a trading halt there as well, but a recovery today. And that recovery pretty broad-based across most of the major markets. We've got the Nikkei also better by about 2.8%. We do have a 30-year JGB auction today that we'll be keeping a close eye on. The yen also softening a little, just below 157 at the moment. Markets in China, meanwhile, after the MPC, which is ongoing, in fact, the CSI 300 having a pretty good day, better by 1.5% at the moment. And Brent crude, well, oil prices unsurprisingly continuing to rise, 83.78 a barrel. Gold also catching a bid in this environment of considerable uncertainty and volatility. Well, China has set its least ambitious growth target in more than 3 decades, in a tacit acknowledgement that the model powering the country's rapid rise is starting to show signs of strain. Let's get over to Beijing now. Our Chief North Asia correspondent Stephen Engle's with us for more on the government's annual work report. Steve.
Yeah, that's right. As you can see behind me, perhaps, if I can step away a little bit, you can see that the delegates are leaving the Great Hall of the People after the conclusion, of course, of Li Qiang, the Premier's work report, where he gave that annual growth target of between 4.5% to 5%. So it's really a range rather than a specific hard target. Now, last year was a bit softer as well, about around 5%. This time they've gone even lower, down as low as 4.5%, giving the policymakers a bit of wiggle room to navigate some of the stresses or the headwinds that the Chinese economy might face this year. Not only externally, of course, after nearly a year of Trump-era tariffs, we have the uncertainty in the Middle East and oil prices and the like. But again, they're buying some time and buying some wiggle room because of the stresses in the domestic economy, the ongoing property mess, the fiscal struggles at the municipal level, and essentially the longer term, over the next 5-year plan of rebalancing the economy and relying more on domestic consumption instead of the main pillars of investment and export. So there are a lot, as Li Qiang ran through the list of challenges and opportunities, those challenges he played up because, again, they are lessening the expectations for stimulus, large-scale stimulus. That is something that Xi Jinping has resisted doing to stoke that very high budget deficit, the debt to GDP ratio at a record high right now. So let's hear what Li Qiang had to say, the premier, about their growth forecast.
The main targets for development this year are as follows. GDP growth of 4.5 to 5%, while striving for better in practice. Surveyed urban unemployment rate of around 5.5%. Over 12 million new urban jobs. CPI increase of around 2%.
So the next task for these delegates who are leaving the Great Hall of the People is to go through and review all those documents and pages for the next five-year plan, the 15th five-year plan, which was essentially solidified at the Central Economic Work Conference in December. It gets ratified, codified here at the NPC. So they have a lot of work to do over the next course of the week before we wrap up on March 12th, Thursday of next week. So again, lower growth expectations, also a 7% increase this year, same as last year for military spending. But many economists and many China watchers we've spoken to expect it actually to be a larger number this year than last year, at a time when the PLA is going through that big purge, if you will, of top generals and a discipline campaign led by President Xi Jinping, not to mention as well the war that has erupted in the Middle East. Not to say that China is going to be sending weapons or being involved in that, but again, as geopolitical tensions rise and war drums are beaten elsewhere outside, China is looking to modernize its large military as well.
So, Steve, with this lower growth target, the lowest since 1991, is it safe to say that the era of big fiscal stimulus in China is done?
I wouldn't say the era of fiscal stimulus is done. It's just recalibrating the model. The Chinese economy is so much larger, and you can't just rely on exports, investment, the old cocktail of debt-fueled growth, right? And just constantly throwing fiscal spending outlays for roads, railways, highways, bridges, airports, and the like. It has to transition more to a domestic consumption-led or balanced economy. So again, it's a different model for different times right now. And something I heard all the time last year at the National People's Congress of all the economic leaders, and by the way, we're going to be hearing from the top economic leaders in a press conference tomorrow afternoon. I'm talking the head of the PBOC, Pan Gongsheng. We're talking the NDRC, the National Development and Reform Commission, which is the top planning body, which basically coordinates those fiscal outlays. Also the finance minister, the commerce minister, and the securities regulator. We're going to be hearing from them tomorrow to see what their marching orders are. And what I heard from them, they talked in unison almost last year. They talked about belt tightening. And that's something I think one thing we gleaned from Premier Li Qiang is that there will be more belt tightening. The time for extravagance is over. It's more about being careful. In fact, he said we need to be clear-eyed about the difficulties and challenges. He wasn't just talking about the domestic economy, obviously. He's also talking about the external situation, making reference as well to the tariff campaign from Donald Trump, saying multilateralism and free trade are under severe threat. So the Chinese government, led by the work report here at the NPC, always, and I've covered several decades of these, they always talk about the challenges being great. So what they do is they're lowering the bar a little bit on expectations with the hope that the conditions will allow them to surpass those numbers.
All right, Bloomberg's chief North Asia correspondent Stephen Engle there in Beijing. Well, let's get some further China insights now with Peiqian Liu, Asia economist at Fidelity International. And Peiqian, I just want to pick up on Steve's observations there about, the old cocktail of debt-fueled growth being over, belt tightening the name of the game, domestic consumption to lead the way. Is domestic consumption really ready to take the lead in terms of Chinese growth here?
Thank you for having me today, Paul. Yes, indeed, there has been a subtle change in the formatting of the government work report, as we hear from Premier Li Qiang's readout. private consumption and domestic consumption has been elevated as one of the top priorities. Now, we don't really expect a wholesale change of a sudden pivot into domestic demand, but the readout did sound a little bit more worried about the environment from the external instabilities and volatilities, and that there is more urgent need to pivot domestic right now.
The MPC is also prioritising new quality productive forces. So it's talking about AI, robotics here as well. Can state-led investments in these kinds of initiatives really replace those old drivers like property and infrastructure investment?
So I think there are two perspectives here to be outlined in terms of understanding China's next phase of priorities. Firstly, of course, we are going to see more resources being developed, deployed into supporting consumption. But secondly, and more importantly, we don't really expect a wholesale change in China's growth drivers. It still leans on domestic investment as well. And now in terms of that composition of investments, it used to be a lot more focused on infrastructure, on real estate, and there has been a much more concerted effort to shift that towards the new economy, as coined by new productive force, which comes in the form of investments in new areas. That investment capital injection is perhaps going to help stabilize a bottom line growth to meet the annual targets, and the counter-cyclical factors and counter-cyclical easings are going to deploy more to consumption to lift the upside of the growth momentum.
And we've got this target range as well of between 4.5% to 5%. Where do you see GDP landing in terms of that range? Closer to the 5% end or closer to the 4.5% end?
Well, according to the initial readout, I think there is an additional phrase after that target's being outlined, saying that with ambition to achieve the higher end of the band. So we do think that it's still encouragement to local government officials to achieve the more ambitious end of the 4.5 to 5%. And I think that upside really comes from a possibility of less external uncertainties and perhaps some elements of an upside surprise coming from the consumption sector.
Also in the report, China setting a CPI growth target of 2%. I'm wondering how achievable you think that is. And you talk about the external environment. I mean, obviously, the conflict in Iran at the moment driving up oil prices. So with that in mind, what's your outlook for CPI in China?
Well, I think in terms of our forecast, we think that CPI will gradually recover this year. There's a case for reflation, but not really a strong reflation. So our forecast is still in the range of between 0.5 to 1.5%, slightly below the targets. But we also have to note that the CPI targets has been lowered since last year from 3% to 2%. So that is a pragmatic downward shift into a new equilibrium, taking into consideration of the new supply and demand dynamics. In terms of the outlook this year for inflation, I think the upside risks or upside outlook really comes from the efforts in anti-involution, addressing of overcapacity on the supply side, which has also been mentioned and highlighted in various sections of the government work report. And on the other hand, lifting domestic demand is definitely going to provide some bottom line support to core CPI, including the services sectors, healthcare, education. But I think that support will come likely in a very gradual and modest way.
The 5-year plan's also got hard numerical targets for consumption as a percentage of GDP. Do you feel like that's a true structural shift, or is it just a new way to measure growth?
Well, I think I read that positively as a signal for a more decisive pivot into consumption. I would like to take this into the context of China's effort in building a dual circulation model. For the past few years, if not decades, China has been focusing a lot more on enhancing its external circulation by developing a manufacturing sector as well as integrating closer or more closely into global supply chain. And now that there has been much more effort pivoting into developing a domestic circulation, making consumption as percentage of GDP one of a quantitative target is a very obvious signal that's being sent in both to the local government and to the market that there will likely to be more coordination into developing the domestic circulation.
Steve was also talking there a moment ago about China's considerable debt to GDP ratio. When you look at that, do you see any risks potentially emerging?
I think in terms of looking at China's debt to GDP ratio, the perspective here is that it really leaves limited resources for the local government and central government to maneuver in terms of supporting domestic growth. But that also means that resources allocation is much more important than the incremental numbers that we're looking out for every year. For this year particularly, I do note that in the government work report, there has been new policy outlook in terms of expanding tax revenue as a percentage of GDP, pivoting away from the old model of leaning more on local government financing vehicles or the likes of land sales revenue. So this change will likely to take long term. It's not going to happen overnight, but that directional change has been made much clearer that the local government financing model is going to change going forward.
Well, of course, this MPC happening against the backdrop of this current conflict in the Middle East. How do you see economic risks to China from this dragging on, and how can they best be managed?
Well, I think the perspective of Middle East conflict to China's growth is really largely depending on the duration of the conflict and how that is going to eventually have an impact on energy prices, on the shipping costs, etc., etc. So in the very short term, I think it has come to a consensus that China is fairly resilient in terms of defending the energy shocks in the short term, just on its large pile of strategic reserves and the ability and policy maneuver to maintain price stability in domestic markets. But that being said, the risk still lingers, especially if the conflict is more prolonged, and we would also expect China to offer some policy flexibility around that if we see a prolonged and protracted interruptions.
Oh, that might be a good place to end it, actually, in terms of policy flexibility. I mean, you're forecasting rate cuts, triple R cuts later this year, but to what degree could the PBOC be a little bit constrained here by the potential for oil-led price spikes?
I think we're definitely looking for incremental cuts in triple R and rate cut. But for this year, it does sound fairly clear to me that fiscal is still going to take the heavy lifting in terms of policy stimulus, and that the shape of the policy is going to be more structural than incrementally broad-based policies. So there are definitely more policies from the structural monetary policy front, as well as elements of fiscal monetary coordination as signaled by the 100 billion of new fiscal financing coordination fund.
All right, Peiqian Liu of Fidelity International, thanks as always for joining us with your analysis. We have plenty more ahead. This is Bloomberg. Welcome back. You're watching Insight, where we were just talking about risks to China from disruption to energy supplies from the conflict in the Middle East. And now China is telling top refiners to suspend diesel and gasoline exports. This is breaking news from China. Officials from the National Development and Reform Commission verbally asking refinery executives for a temporary suspension of refined product shipments. Worth noting that while China has a huge refining sector, most of it does go to domestic demand. But the fact that China is telling refiners to prioritize the domestic sector. An interesting development. We've got crude price there, Brent 83.76 at the moment. Well, Goldman Sachs CEO David Solomon says the initial market reaction to the Iran war has been relatively benign. Speaking to Bloomberg exclusively at the bank's Australia Week event, Solomon said investors are awaiting more information on the direction and the duration of the conflict.
I don't see complacency. I think there's a lot of uncertainty around the direction of the conflict, how it'll be resolved, what the off-ramps are. And, I think it's fair to say when you look at markets, market reactions have been relatively benign. And I certainly could have seen over the last couple of days, a little bit more volatility. But I don't think people are being complacent. I think that market participants are looking and trying to say, how is this going to play out? What's the end game? You can see, good scenarios and more difficult scenarios. And as they have more information in the coming days, the coming week or two, I think that will have an impact on risk premiums. I think at the moment what market participants are really looking at is this going to translate through to things that affect economic growth and activity, particularly energy supply chains? So far, I think one of the reasons why markets are reacting the way they are is they're encouraged that there is strong support for trying to ensure that doesn't happen, but it's uncertain. You don't know. And we'll see. In the long run for portfolio allocation, and I know Peter Oppenheimer, Sharmeen Mossavar-Ramari did a call for our wealth clients. If you have portfolio allocation, there's nobody that's saying you should change your fundamental portfolio allocation because of what's going on. But for traders and day-to-day market participants that think about risk premia, every single day, obviously they're watching very closely.
What about the people that run big, major global banks like yours, right? Do you worry about the lack of predictability when it comes to policy, when it comes to how this potentially ends and when it ends? What's going on with your Middle East operations, for example?
I worry about a lot of things. We run a big global business. We have an extraordinary team. And, I think one of the things that we have to accept is the world is a very complicated place. There's always a lot of uncertainty. There's always a lot of nuance. But we have, base beliefs on how economies will perform, how the world will evolve. And, we operate around that, but we always are prepared to risk manage and think about downside risks. And I think one of the things you have to do when you run a big, large financial institution is that when, facts change or risks come up, you've always got to be prepared to pivot, to shift, to de-risk. And, we run our business, that way always. We run a big balance sheet and we think about that every day. But there's nothing, while these are very, very significant events, and I don't want to diminish them in any stretch, we've operated the firm through lots of very significant events year in, year out, and that's part of what we do.
Is it business as normal then for, say, your offices in Saudi Arabia? Is there still travel going on? What's the communication been with clients?
That is complex. We've got a significant number of people in those Middle East countries, and obviously, first and foremost, we're concerned with their safety. And we're trying to do everything we can to support them and their families. I would not say, it's business as usual in those markets. All those markets for all businesses, are operating work from home and stay safe as a first priority. And so we'll just have to watch closely, how things play out. And, we're very, very focused on making sure our people and their families are safe and sound. And at the moment, that's our primary focus in that part of the world.
Do you think there is a bit of an existential cloud over Dubai as a financial center now?
Well, I do think safety and security, matters. And I wouldn't say, I think it's a little bit premature to talk about existential clouds. But, if you're living and operating in a place and you didn't anticipate this, it's quite scary and it's quite unsettling. And so, as I said, our primary focus is on the safety and security of our people there. And we're working very hard to make sure that we're protecting them and their families.
Still to come, Asian stocks bounce back despite lingering Iran war fears. Veteran investor Rajeev De Mello is going to join us next to discuss what's ahead for global markets. This is Bloomberg. All right, right, welcome back. You're watching Insight. Let's take a quick look at where markets stand at the moment. We do have mainland Chinese markets heading off for lunch. Japan markets, meanwhile, coming back online, and we're already seeing the Nikkei continuing its upward climb by 2.7%. Most of the major markets rebounding off the heavy selling that we've seen so far this week. We are also awaiting the results of a 30-year bond auction in Japan. We'll bring you that, assuming that it's newsworthy. We'll keep an eye on that for you, though. The Kospi, though, the story of the day in terms of equity price movements. Take a look at that. It's off session highs, in fact, but still better by 9.67% at the moment. Watching Thailand as well, better by 1.8%. They had a pretty rough ride as well. Thailand yesterday, worst day in almost 6 years, even had a trading halt at one point. We'll be getting CPI data out of Thailand shortly also. It's just dropping now, in fact, contracting a little bit more than expected by almost 0.9%. Elsewhere, markets in China better by 1.3%. Crude and gold both rising, which is perhaps unsurprising. We're also keeping an eye on the Indian rupee. It tumbled to a fresh record low on Wednesday. We've got the rupee at the moment still pretty soft, 91.63 right now. Now, it's of course uncertainty about the conflict in Iran. It's forcing investors to look to recent history as a guide for markets, particularly Russia's 2022 invasion of Ukraine. Bloomberg's chief Asia FX and rates correspondent Ruth Carson joins us now with more. So Ruth, why is the invasion of Ukraine becoming such a useful and critical reference point?
Uncertainty is so high and market volatility is so high that it's headline by headline trading. Now, that's unsustainable. So traders everywhere are asking the question, what do we do? Is there a reference point in history that we can sort of latch on to see what happens next? And increasingly, we're seeing, brokers and sell-side analysts from JP Morgan, Mizuho, Macquarie Hive actually coming out to say there are parallels here that we are seeing, some parallels to 2022 when Russia invaded Ukraine. Back then and even now, we saw immediately oil prices, energy prices skyrocket. The dollar, the ultimate haven, king dollar, actually winning more than anything else out there. Yen, Swissy, everything is secondary. Even treasuries, which we know are the most liquid bonds in markets, they're getting sold off because of inflation fears. So is there a playbook that people are referring to? The closest that we're seeing right now is 2022.
Yeah, it's not completely the same, though, is it? Because Russia-Ukraine doesn't have a thing called the Straits of Hormuz, which is only 33 kilometres wide at its narrowest point. Are things different when you're comparing this conflict with Russia's invasion of Ukraine?
Yeah, it's a great question, because are the stakes higher this time around? Yes. A lot of people are saying the answer is yes. While oil is not at the levels that we saw in 2022, it is off a lower base. And on top of that, you still have inflationary fears. Bond yields are already higher as it is. And so people are asking the question, could this be a bigger problem for the world when it comes to inflation? And the answer is yes, which is why, again, we're seeing that turbocharge or the supercharge into the dollar, right, against everything. It's not just against emerging market currencies. It's against G10. It is by far the biggest winner this week in markets. And could this continue? Yeah, definitely.
So what are investors saying when it comes to finding a good haven right now? Is there any indication from the 2022 playbook there?
What's interesting was back in 2022, if we look at, say, for example, February through to the end of the year, we saw that gold, for example, actually fell. Treasury yields skyrocketed again because of inflation fears. The one thing that was consistent was the dollar. The dollar actually won, because ultimately you need the dollar to pay for your energy costs. You need the dollar to settle trade. Let's remember that the dollar is on about 90%, 89% of all foreign exchange transactions. So there is that rush to the dollar as the ultimate haven. You can put the dollar to work elsewhere, but for now, rush into the dollar.
All right, Bloomberg's chief correspondent for FX and rates in Asia, Ruth Carson there. Federal Reserve Governor Stephen Miran, meanwhile, says the US central bank should continue cutting interest rates despite the ongoing war in Iran. He also told us how policymakers are evaluating the potential impact of the conflict on the US economy.
At the moment, I think it's too early to sort of have any firm views as a result of that. Oil's gone up a bit, but the bigger question is, does oil stay up or does it come back down? And that, of course, will depend on how things play out. But even that said, even if oil stays at these types of levels, to me, it's difficult to get a lot of read-through as a result of that. Sure, oil will feed into headline inflation, but the evidence that it feeds into core inflation in any sort of material way, unless there's a huge move in oil prices, I think is quite limited. So it's difficult for me to get very excited about a policy implication of what's happened thus far.
So some people who come on the programme, spoke to Lisa and I, and said these Federal Reserve officials might be conditioned by the post-pandemic experience coming out of 21 into 22 and the inflation spike then and the energy shock that developed at the time emanating in Russia. Is this different? Are we in a different place?
I think it is. I think that attitude is a little bit of fighting the last war. And I think that the Federal Reserve for decades has had the view that, that headline inflation shocks like oil are best looked through, and you sort of focus on core inflation because it's indicative of where inflation is going to go in the future, and you focus on the labor market. And that type of reasoning leads you to look through an oil shock. Now, of course, what happened in 2022 was a bit different because the other policy settings were different, right? Don't forget, monetary policy was as expansionary as it had ever been at the time. Fiscal policy was injecting trillions of dollars into an economy that was recovering thanks to vaccines and medical improvements and COVID passing on its own. And so the policy environment was very different. And so it was very easy for a slightly inflationary shock to feed through into the broader economy and create this type of persistent inflationary problem that the Fed dealt with. We don't have that right now. We don't have fiscal policy that's slamming on demand. In fact, if anything, supply is moving out quite aggressively, and monetary policy is still modestly restrictive in my view. So the policy settings, the economic environment is different. To focus on that, as you described a moment ago, to me, is fighting the last war. That was a unique circumstance.
At the same time, some people have argued that the January jobs report raised a question about just how weak the labor market actually was. Even Governor Chris Waller came out and said, OK, now it's a coin flip for whether we should cut rates at the March meeting. If we do get confirmation of that strength with the February payrolls report that we get on Friday, would that make you rethink whether March was an appropriate time to cut rates?
So look, for me, we've got 2 years of a trend, 2+ years of a trend of gradually weakening labor markets that sort of set in 2023. It's way too early to reject the notion that trend continues based on 1 or 2 labor market reports. And when you look at the totality of labor market data, there's still evidence to me that it needs more support from monetary policy.
US Federal Reserve Governor Stephen Miran there, speaking with Bloomberg's Jonathan Ferro and Lisa Abramowicz. Let's get a little bit more on markets now with Rajeev De Mello, CIO of Gamma Asset Management. Rajeev, thanks so much for joining us today. And I just want to pick up on Stephen Miran's remarks there. He'd still like to see a cut. What do you think? Is there a bit of inflation risk involved with that path?
Well, it's been 5 years since the Fed hasn't been at its target of 2% inflation. So when he dismisses a little bit what happened in 2022, I think he might have forgotten that, agents, consumers and businesses now are used to an inflation which is at 3%, not at 2% where the target is. And that's a worrying thing in this environment. If you have an oil shock which increases prices, even if they're headline prices, that's not very good for what's already priced in the market, which are 2 rate cuts for the rest of this year. So inflation is a risk to be taken seriously.
So what's your outlook then? Do you think we're going to get those 2 rate cuts, or are we going to have the same sort of disappointment this year that we had in 2025 in terms of people expecting the Fed to be more dovish?
I think it'll depend very much on how this oil shock continues. I mean, the war is ongoing. It's probably too early to say whether oil prices can come down quickly with the risk to the Strait of Hormuz. I mean, so many ships are caught inside and can't carry oil outside of the straits. And Asia depends a lot on oil from the Middle East. Europe depends a lot on gas from Qatar and the Middle East. Both sides were both on oil and on gas, and especially in gas, we're seeing significantly higher prices. So it is going to be a challenge for inflation. So I think one has to be a bit more cautious about these 2 rate hikes priced if oil and this war and oil prices stay high for a period of time.
Yeah, while you're talking there, we do see a chart on the screen which shows US natural gas prices really barely moved since this conflict began, but European natural gas prices have spiked. To what degree is the US relatively insulated from this, and to what degree does this spell a bit of trouble for other markets?
Yes, exactly, and that's a point Ruth was making earlier. I mean, the U.S. is somewhat insulated, and so that's good news for the dollar. It's more difficult for big importers of oil and gas, notably in emerging markets, in Asia as well. And we saw big moves down in Asian equity markets over the past few days, a bit of a rebound today. But that is a worry for Asia and for other emerging market countries as well. This big spike in oil. And yes, as you say, the U.S. produces a lot, so it isn't affected as much and is far from the conflict as well.
Yeah, well, as you say, there's a lot of uncertainty. It's difficult to say how long this will go for, how high the oil price could potentially go, but also difficult to quantify. What's the impact on confidence here and the knock-on effect for investment?
Yes, that's the other channel. So one is the oil channel we talked about, and the other one is business confidence. The longer this conflict lasts, the more it will sap confidence. Investors, whether they're real investors in factories or whether they are portfolio investors, are going to hold back until they see a bit more clarity. Now, once we start seeing signs that we're getting towards the end of this conflict in some way or another, then people will relax again and it wouldn't hit confidence too much. But if this broadens further, there is a risk that confidence is hit. Business confidence is just recovering and doing quite well until just before this war started.
Well, you're a chief investment officer, which is a challenging job in this sort of environment. So where do you put money to work right now?
Yeah, I think one has to be extremely close to the markets. The idea is to see whether this is going to be more prolonged or we're going to see less bad news. I mean, the bad news is there. War is always bad. But does it get worse, or are we seeing some signs of stabilization? And it could happen very quickly. Things turn around on a dime. We already see less rockets fired by Iran into the neighboring countries, which is a good sign. But it might be too early to get back into the markets fully. But one has to be quite cautious not to get too negative either, because things could end very quickly, as we've seen with many geopolitical crises. Their effects are limited in time and in magnitude as well.
Well, we are seeing some aggressive dip buying today, particularly in the Kospi, rebounding just as sharply as it sank the day before. Is this a good time to be a dip buyer, considering some of those old themes like, the AI revolution, semiconductors, all those themes are still intact? Can you go there at the moment?
Exactly. I mean, those underlying themes of AI on the positive side for Korea and for Taiwan are there. And so one shouldn't give up on those. Those are much more medium to longer term themes as well, with a great demand for those advanced semis and memory as well. So I wouldn't abandon that thesis, but I would. But I do caution, because one of the reasons I think that the Kospi and the topics as well fell so sharply is that they were leading markets last year and up to the 27th of February. So investors had to take profits where there were profits to be taken to fund other parts of their portfolios.
All right, Rajeev De Mello, CIA of Gamma Asset Management, is sticking around. We'll talk about India in a moment. Just want to take you back to Japan, though. I said you'd bring you the results of the 30-year bond auction. It went pretty well, actually. The bid cover ratio, 3.66. That's better than the 12-month average of 3.34. The tail, or the gap between the average and lowest accepted prices, 0.12. That was compared with 0.11 the previous month. So a better than expected 30-year bond sale in Japan. All right, as promised, when we come back, we will discuss the outlook for Indian markets as New Delhi steps up plans to shield its economy from the conflict in the Middle East. This is Bloomberg. Welcome back. You're watching Insights. Let's take a look at how Indian markets are tracking. Been trading for just over 3 minutes now, and much as we've seen across the region, we're seeing some gains there, although more modest than what we've seen elsewhere in the Asia Pacific. The Sensex better by 0.5%. The Nifty Bank Index better by 0.4%. And the rupee losing ground there, 91.57 against the greenback, and it did hit a fresh record low on Wednesday. Rajeev De Mello, CIO of Gamma Asset Management, is still with us. So, Rajeev, I want to pick up on the rupee. We've got a very weak rupee, the oil price rising as well. The RBI intervened yesterday, but are we starting to hit the limits of what intervention can achieve in terms of supporting India's currency?
Yes, I think so. I think we are hitting those kind of limits. What's difficult for India is twofold from this crisis in the Middle East. One is the higher oil prices, and India imports a lot of oil and just made a deal that it would buy less Russian oil, so that means it's paying full price. So higher prices impact India directly through inflation and through deterioration of its current account. The second factor is that so many Indians, I think there are 9 million Indians in the Middle East, and they are a big contributor to the remittances, which is an important part of inflows into India. And a turmoil in the Middle East will affect India through that channel as well. So very difficult for India. RBI is a bit stuck about cutting rates. I mean, inflation in India is low. It's lower than the target. So the RBI could cut rates, but it did indicate it was more hawkish. It's more concerned about inflation. That was before the war. And now with the higher oil prices, that's going to remove any reason for the RBI to consider a cut, and especially, as you mentioned, with the weakening rupee as well. So a difficult situation for them.
Where do you see the floor being for the rupee? How much more weakness could we potentially see if this conflict does drag on?
Well, since the central bank has been intervening to reduce volatility or to calm the weakening of the rupee, once they decide that, well, they don't want to use their reserves, we could see a further weakening in the rupee. But this is if the oil price remains at this high level and the conflict continues. Our base case is that we'll see some kind of calming down of that. So that's why we're not as worried about the rupee. And at these levels, the rupee on a fundamental basis is actually very cheap.
So, more broadly, we were talking about this in the context of China a little bit earlier in the show and the risks to the economy the longer the conflict in the Middle East continues. Do you see similar risks for India potentially?
Yes, prolonged conflict is a risk for India as well. That would keep the oil prices higher. It would be a problem for India's current account balance, less portfolio inflows as well, with a sort of risk-off sentiment which would persist. So there is a significant downside for India if this conflict continues.
And we've got bond yields rising as well. To what degree do you see that complicating the picture for the RBI going forward?
Yeah, bond yields have been rising. They've been rising for a little while in India. And even though policy rates have remained stable and the RBI was unchanged at its most latest policy meeting, the rising bond yields are a bit of a global phenomena with these higher oil prices as well, and these worries about fiscal spending, which have hit bond markets everywhere. I mean, it's quite amazing to see that none of the bond markets had big rallies on a risk-off sentiment at the beginning of the week. They were clearly not the safe haven that they were in the past.
Yeah, and what are your expectations around inflationary pressures as well? Because it's not a great combination, a weak currency and a rising oil price.
Yes, and that does make things difficult. The only good thing for India is that the starting point for inflation has been very low. India had a very, very low inflation rate at the end of last year, thanks to lower food prices for sure. So it's not as though India is starting at a position where inflation is high. In fact, real interest rates, that means interest rates, policy rates in India, less inflation, are quite high. So that is the good thing for the RBI.
So let's talk about Indian stocks as well. We've seen a lot of foreign outflows as well. Would you be a buyer of Indian equities at the moment?
Well, at the moment, with the current uncertainty around the Gulf War and around oil prices, not yet. Most emerging market equities have done very well. India has underperformed significantly. Year to date, Indian equities are down 6% or more in local currencies and 8.5% in dollar terms. So they are starting to look attractive, but it's too early to get into Indian equities until the Gulf War situation stabilizes.
Mm-hmm. Not even with the view of getting long, because with the weak rupee, this must be a reasonably attractive proposition at the moment.
Yes, absolutely. I mean, this Indian equities started from a very high valuation point a year and a half ago, and then they've normalized somewhat. But remember that some of the favorite Indian stocks are also linked to the software side, which is under pressure globally. So those darlings are more difficult to buy right now.
Do you anticipate any support from the Indian government?
Well, the Indian government's policy adjustments are ongoing. They are implementing structural reforms. The positive side is the growth rate still remains one of the highest in the world. So that's something which is positive as well. And so when the consumers are stabilized and they see the oil shock either limited in time or limited in scope, then we can see the consumers come back, and that would be positive for India as well.
All right, Rajeev De Mello, CIO of Gamma Asset Management, thanks so much for joining us today. Still to come, as the Iran war's duration, goals and outcome remain uncertain, we'll talk through the possibilities with the University of Tehran Professor Hamed Mousavi. Plus, Macquarie's Aditya Suresh is going to give us his outlook for Indian markets after this week's sell-off. All that and more to come in our next hour of insight. Keep it here with us. This is Bloomberg.
We're doing very well on the war front. We're in a very strong position now, and their leadership is just rapidly going. Everybody that seems to want to be a leader, they end up dead. Their missiles are being wiped out rapidly. Their launchers are being wiped out. We're in very good shape now. I want to let you know that, and we will continue forward.
Welcome back. You're watching Insight, and that was President Trump expressing optimism over the U.S. military campaign against Iran, even as the timeline for operations and its ultimate goals remain unclear. Let's get to Dubai now and bring in Horizon's Middle East and Africa anchor, Joumanna Bercetche. Joumanna, we also heard the president saying U.S. ballistic missile strikes from Iran are down 86%. I mean, you're in Dubai, which has been on the receiving end of some of those strikes. Have you noticed things becoming quieter, and what's happening on the ground?
Yeah, well, maybe let's just go back to how President Trump is framing the operation so far. We are entering to day 6 of this war, Paul, and President Trump had said overnight comments, we are doing very well. We're doing very well on the war front. We have absolute air superiority over Iran. But at the same time, I think there are still many lingering questions about exactly how long this war is going to go on for. They've stated numerous objectives that they're trying to achieve, including destroying Iran's missile capabilities, their navy, their nuclear capabilities, stopping the Iranian regime from sponsoring terrorism. And then we haven't even gone on to the weightier subject of possible regime change as well. Can that all be accomplished in a matter of days? And at what point will the U.S. say, that they have done enough in terms of achieving those objectives. Now, at the same time, what we are seeing is still very much live war. The conflict continues to expand. The war continues to expand in the region. Yesterday, even a ballistic missile being fired towards Turkey that was shot down by NATO. That's the 13th country that is now being drawn into this conflict. But I will say, to go back to what you just asked me, in terms of the munitions that Iran are deploying, what's become clear over the last couple of days, just in the last 48 hours, is they're relying more intensively on drones as opposed to ballistic missiles. And there are two possible reasons for this. Number one, they could be preserving their more advanced weapons to use later on. Or it could be a matter of the fact that they're simply getting low on that supply. And if you listen to what the US have said, what the IDF have said, they have managed to successfully take out many missile launchers. It's unclear at this point how many ballistic missiles Iran are still sitting on and whether they're preserving that for a later date. So still many unknowns, but these strikes, even with the drones, are causing significant damage. And you saw another attempted strike yesterday on that Ras Tanura refining facility in Saudi Arabia. Just a short while ago, China saying it's telling its top refiners to suspend diesel and gasoline exports. So what is happening in this part of the world still very much having knock-on effects on global energy and financial markets.
Yeah, not just a risk to energy supply. Flights are, of course, still disrupted as well. Is there also a risk of mass displacement of people coming?
Absolutely. And the UNHCR, that is the UN Refugee Agency, estimated that since the start of the war, 100,000 people have left Iran. They've also given some updated figures on the new front that's opened up in Lebanon as well, alongside the Lebanese Ministry of Social Affairs. Yesterday, the IDF issued an evacuation notice to Lebanese residents in the southern part of the country to move to north of Litani. That has led to the displacement of over 83,000 people, 12,000 families now being hosted in shelters around Lebanon and other parts of the country, with the UNICEF, which is the children and housing agency, saying that they're very close to full capacity there. And as it comes to overall flight disruption, we have updated figures per RBN reporting. Almost 23,000 flights have been canceled now, which equates to around 4.4 million seats. This is in and around the region. And many of the airports are still operating with very limited capacity, though the UAE did say yesterday that they're going to allow for as many as 48 flights an hour. They might up that number to 80. But the biggest and most active airline in the world, that is Emirates Airlines, have suspended flights once again, most flights, commercial flights, until Saturday, Qatar Airways until Friday. And at the same time, you have a growing list of nationals looking to get out of the country. The UK, it's estimated that around 300,000 British nationals live in the area that have registered their interest to leave. And then, of course, there was that State Department notice that went out a couple of days ago urging American citizens to leave as well, which led for a bit of a scramble to the exit because of limited options. But chartered flights have begun to take off now from the region as well.
All right, Horizon's Middle East and Africa anchor Joumanna Bercetche there. Well, the US submarine has sunk an Iranian warship in the first torpedo attack on a surface vessel by US forces since World War II. Sri Lankan authorities say the Iranian frigate sank on Wednesday off the island's coast and close to Indian waters, with 32 sailors rescued and more than 100 missing or dead. Bloomberg Economics says the incident has unsettled India's calibrated response to the war in the Middle East. Their geonomics analysts say the episode risks frictions with Washington and domestic embarrassment for Indian Prime Minister Narendra Modi's government. For more on this, let's bring in Executive Editor for Economy and Government in Asia, Daniel Tenkate. Daniel, this is quite a significant and interesting escalation. The ship that was targeted thousands of kilometres away from the conflict zone. How significant is this, and what's the reaction going to be?
Yeah, it's very significant. It hasn't happened since World War II, as Pete Hegseth said last night. And for India in particular, it's definitely concerning. These are waters not far from India's coastline in the Indian Ocean. Everyone knows there's U.S. subs there, but to take this kind of action is really comes as a shock to the region. Not only concerns that the wider war might spread, but this ship was in India doing a port visit at a fleet review before this. So India was essentially hosting the Iranians and a bunch of other countries, including Russia and the U.S. at the time. And this ship was sailing back from that event. So there is domestic fallout now. There's a lot of shock in India at this event, because essentially you've been hosting these guests, you've been telling them to come over, then on the way home, they got shot and a lot of people died.
So what are the implications here for the Indian Prime Minister Narendra Modi in terms of the tightrope that he needs to walk? And have we heard from Sri Lanka?
Yes, we have heard from Sri Lanka. We have not heard from Modi yet. And I think that's one of the big things we're waiting for, is how does he respond? He's had to carefully walk the tightrope, as you said, with the Trump administration, not just with the Iran war, but also with Russia, with India's relationship with Russia. Trump heightened tariffs on India for buying Russian oil last year. Those just came down earlier this year. They signed a trade deal. Modi was also in Israel right before the war began. So he's already come under domestic criticism for that, for getting too close to Israel in this. And now you have this incident where India was hosting the Iranians, and the warship was sunk not far from India on its way back. So there's a lot of domestic anger in India, and how Modi responds to that will be very interesting. We expect today that parties will come out and be critical of him and ask him to take a firmer stand, kind of condemning this action. Whether he's going to do that or not, probably not, but it'll be interesting to see what he does today.
All right, Bloomberg's executive editor for Asia Economy Government Coverage, Daniel Tankate there. Our next guest specialises in Middle East studies and foreign policy. Hamed Mousavi is Professor of Political Science and International Relations at the University of Tehran. Professor, thank you so much for joining us today. I'd like to start, if I can, by gauging what you would assess to be the reaction on the ground in Iran to these attacks. I mean, President Trump is calling on the population to rise up and take control of the government, or does getting bombed by a foreign power have the opposite effect?
Yes, so that's a message that the Trump administration has been repeating from the start of the war. Nevertheless, we really haven't seen any significant protests in Iran. And I think this is similar to what happened in the 12-day war in the summer. When there's a foreign attack on Iran, it essentially strengthens nationalism. So even people who are quite critical of the government, they are probably not going to be they're not going to like being attacked by a foreign power. We have to understand that Iran has a very difficult and negative relationship with foreign interventions, whether it was during World War II when the Russians and the British occupied Iran, or the 1953 coup d'etat by the MI6 and the CIA. These kinds of foreign interventions have usually been very bad for the Iranian people. So I think the sentiment on the ground is not really conducive towards American interests. And I think as the war drags on and there's more casualties, one thing important to point out is that there's been over 1,100 civilian casualties in the past 5 days. Comparatively, in the 12-day war, 1,000 civilians died in Iran. So this is more than all the civilians that died during that war. And this includes the 165 elementary school girls that were killed in the city of Miran. So I think if the war drags on even further, the sentiment in Iran regarding this foreign intervention is going to become even more negative.
How well placed is Iran's leadership, and we're not sure what the leadership is at the moment, we'll get to that, but how well placed are they to drag out this conflict and make it as uncomfortable as possible for the US and Israel?
I think both sides are racing for time, racing against time, actually. So The Iranians, the big question is how long can they sustain this? How long can they keep attacking U.S. forces and U.S. bases and the Israeli forces in the region, compared to how long the Americans and the Israelis are able to keep their air defenses, because we also know that they have limited air defense munitions. So it's going to really become a question of which side runs out of munitions first. From the Iranian side, aside from how long they have, how many missiles they have, is a question of whether they will be able to launch them. But nevertheless, I think we are still at least a week or two away from that point. And until we reach that point, I don't think there's really going to be a chance for a ceasefire.
Well, we're anticipating the appointment of a new supreme leader, and it seems it's likely to be Mojtaba Khamenei, the son of the recently assassinated supreme leader. Is it safe to assume that we're not going to see any change in Iran's foreign or domestic policies?
Well, there hasn't been an official announcement yet. There's much speculation. If the decision is actually made that Mojtaba is to become the next supreme leader, that's going to be a very controversial decision within Iran, because we have to remember that this is actually not a monarchy. The 1979 revolution actually came to abolish the monarchy. So power being down in a hereditary way is really not the norm. Nevertheless, I think there's also the question of whoever gets appointed to the position of supreme leader will become the next target for the Americans and the Israelis. So I think that's why we have seen a delay in terms of the announcement of who the next supreme leader is. This might even drag on further. At the same time, I think the Iranian government wants to project that it's still pretty much in charge, that there's order. So there has to be this balancing of not dragging it out too long. So, you're still projecting that you're pretty much in charge, versus the issue of the danger of the next supreme leader getting assassinated.
Well, we had a report earlier that the CIA had been in contact with Iran to try to negotiate an end to the fighting. Iran has denied that there is any CIA contact. But as you rightly point out, whoever is elected, the next leader is presumably going to be a target. Is this just going to be a case of the US just continues to decapitate the leadership until it finds someone who is willing to talk?
Yes, I mean, that's definitely a possibility. No one really knows if Mojtaba actually becomes the next supreme leader. He's been a very elusive and shadowy figure within Iranian politics. Very few people actually know what his positions are, but he's generally known as being close to the IRGC. So again, even if he becomes the next supreme leader, it's very difficult to say what his policy will be regarding negotiations with the Americans. Nevertheless, I think we're still at least a week or two away from the point where the two sides can reach an understanding of stopping this war. I think at the end of the day, this will be devastating both for the Iranians, especially the Iranian people, if this war drags on, as well as Donald Trump. I mean, this is an election year. He doesn't want oil prices and gas prices to go up. He's being pressured by the Democrats at home. So I think at least a few weeks from now, we will be in a position where both sides will come to an understanding of stopping this war. The issue of the Israelis is a different issue. I think they might actually be interested in dragging this war even further.
If you're correct, and within a few weeks we do see hostilities starting to wind down, how is peace going to be brought about, do you imagine? And what does the post-war environment look like?
So we have the experience of the 12-day war from the summer, and that war essentially the two sides agreed to a ceasefire. It wasn't really a peace deal. It was just the two sides agreeing that they will stop hostilities for now. And I think that is going to be the more likely scenario. After the war, of course, there is the possibility of negotiations and reaching a deal. Nevertheless, we have to also remember that negotiating and reaching a deal with the Trump administration is quite hard. This is an administration that has very little patience The original nuclear deal, the JCPOA, during the Obama administration, took almost 2 years to negotiate. With Donald Trump, he wants everything to be done very quickly. He has high demands. There's very little room for negotiation. So if even we see a ceasefire, it's going to be a shaky ceasefire, being dependent on Iran and the U.S. reaching an actual deal to cease hostilities. And until we see that, there's going to be chance for even further conflict down the road. I don't know, 6 months from now, a year from now. So it's a very volatile situation, unfortunately.
Can you see a scenario in which the theocracy is toppled, which is one of the aims of the US and Israel? And if that were to be the case, what would replace it? I mean, Iran was once a democratic country. Could it be so again?
So before the war started and at the initial stages, what we were hearing from the Trump administration was the idea of regime change. Of course, the narrative of the Trump administration keeps shifting. So, for example, 2 months ago, they were talking about human rights and humanitarian intervention. Nevertheless, right now, they're not really talking that much about it. At the beginning of the war, they were talking about regime change, but during the past 5 days, it seems that they're moving more towards having a government that is more in line with U.S. interests rather than complete regime change. And I think that goes back to the fact that it's very difficult to achieve regime change unless you have ground forces in the war, which the Americans and the Israelis do not, and I don't think they will use ground forces. Without that, and without any sort of massive protest that at least up to now seems quite unlikely, I think the chances of actually toppling the Islamic Republic are not very high. Of course, this is a very fluid situation, but that doesn't seem like it doesn't seem like a likely scenario for now.
There are also reports that the US is in talks to arm separatist Kurds. I mean, what would the impact of that be on the war, and could that potentially lead to some, unintended consequences?
If that happens, that would be a very serious escalation. Essentially, the war up to now has been a war in the sea and in the air. That would add a land dimension to the war. Nevertheless, that would be a very controversial decision by the Americans, because we have to remember that these Kurds are actually separatists. So they are trying to cut out a chunk of Iran and form a state. That's going to also be very touchy, both with the Turks and with the Iraqis, which also have Kurdish populations. Also, if that happens, I think the nationalist sentiment in Iran will grow immensely, because you have to understand that most Iranians are in favor of territorial integrity of Iran, and this includes even the monarchists.
Hamed, we're out of time, unfortunately, but thank you so much for joining us. That is Hamed Mousavi from the University of Tehran. Well, former U.S. Secretary of State Antony Blinken says an off-ramp for the Iran conflict will be governed by two factors: munitions and markets. Blinken also told us exclusively that the Trump administration's public justifications for the war keep on changing.
What I'm worried about, one of the things I'm worried about, and this gets to the second and third order consequences, is we so deplete our arsenal, and it takes a long time to rebuild it, that puts us in a disadvantageous position when it comes to, say, a China or a Russia. All of those things need to be factored in. And again, it's one of the reasons why if you're going to undertake something like this, you've got to make sure that you've factored all of that in. And again, it really should start with explaining to the American people why you're doing something, why it's necessary, why now.
Do you see an off-ramp anywhere at this point?
I do, in the sense that, one, as I said, I think the off-ramp will be governed by this question of munitions and markets. And then what is that off-ramp? I think the president may simply declare victory. He'll say, got rid of the Ayatollah. We diminished or degraded or destroyed their nuclear program. Again, we did the same thing to the missile program. We did the same thing to the Navy. And as to the regime, well, over to the Iranian people. Good luck to them. Hope they succeed. And if they don't, it's their fault. If they do, we'll take the credit. How Iran responds to that remains to be seen. And for the regime, survival is success. Right now, the expectation seems to be, at least as has been reported, that the Ayatollah's son is his successor. He's very tied into the IRGC. And so you may have a situation where, much as we want, and everyone should want to see a change in that regime, we have, regime change without regime change.
Status quo.
Status quo. And even potentially, even worse, because it may simply ultimately reinforce the IRGC, the military, the specialized military. And part of the problem with these things is that it's very hard to produce regime change from outside. You can't bomb your way to it. We've had a lot of experience with that, and not such good experience over the last 20 years. It's even not so likely to come from the streets, even with the extraordinarily courageous Iranian people. It's more likely to come from kind of within the palace. And then it could go in any one of, multiple directions. You could get more pragmatic people, not good guys, but more pragmatic people who are open to, curbing the excesses of the regime, focusing at home instead of focusing abroad, doing deals. But right now, it looks more likely that you're going to have hardliners.
We have plenty more to come. This is Bloomberg. Let's take a look at our Asia benchmarks tracking and broadly risk on day. We've got the Nifty up about 0.7%, but take a look at the Kospi, better by 9.3%. It's actually off session highs. Defence stocks performing well, but every sector in Korea bouncing back strongly from the big sell-off that we saw on Wednesday. Stocks in Japan also better by 2%. We had a pretty good 30-year bond sale, drawing a better than expected bid to cover ratio. More to come in a moment. We'll talk about Indian stocks as the Iran war exposes the country's economic vulnerabilities. Welcome back. You're watching Insight. Goldman Sachs CEO David Solomon says the initial market reaction to the Iran war has been relatively benign. Speaking to Bloomberg exclusively at the bank's Australia Week event, Solomon said investors are awaiting more information on the direction and duration of the conflict.
I don't see complacency. I think there's a lot of uncertainty around the direction of the conflict, how it'll be resolved. What the off-ramps are. And, I think it's fair to say when you look at markets, market reactions have been relatively benign. And I certainly could have seen over the last couple of days, a little bit more volatility. But I don't think people are being complacent. I think that market participants are looking and trying to say, how is this going to play out? What's the end game? You can see, good scenarios and more difficult scenarios. And as they have more information in the coming days, the coming week or two, I think that will have an impact on risk premiums. I think at the moment what market participants are really looking at is this going to translate through to things that affect economic growth and activity, particularly energy supply chains? So far, I think one of the reasons why markets are reacting the way they are is they're encouraged that there's strong support for trying to ensure that doesn't happen, but it's uncertain. You don't know. And we'll see. In the long run for portfolio allocation, and I know Peter Oppenheimer, Sharmeen Mossavar-Ramari did a call for our wealth clients. If you have portfolio allocation, there's nobody that's saying you should change your fundamental portfolio allocation because of what's going on. But for traders and day-to-day market participants that think about risk premia, every single day, obviously they're watching very closely.
What about the people that run big, major global banks like yours, right? Do you worry about the lack of predictability when it comes to policy, when it comes to how this potentially ends and when it ends? What's going on with your Middle East operations, for example?
I worry about a lot of things. We run a big global business. We have an extraordinary team. And, I think one of the things that we have to accept is the world is a very complicated place. There's always a lot of uncertainty. There's always a lot of nuance. But we have, base beliefs on how economies will perform, how the world will evolve. And, we operate around that, but we always are prepared to risk manage and think about downside risks. And I think one of the things you have to do when you run a big, large financial institution is that when, facts change or risks come up, you've always got to be prepared to pivot, to shift, to de-risk. And, we run our business, that way always. We run a big balance sheet, and we think about that every day. But there's nothing, while these are very, very significant events, and I don't want to diminish them in any stretch, we've operated the firm through lots of very significant events year in, year out, and that's part of what we do.
Is it business as normal then for, say, your offices in Saudi Arabia? Is there still travel going on? What's the communication being with clients?
That is complex. We've got a significant number of people in those Middle East countries, and obviously, first and foremost, we're concerned with their safety. We're trying to do everything we can to support them and their families. I would not say, it's business as usual in those markets. All those markets for all businesses, are operating work from home and stay safe as a first priority. And so we'll just have to watch closely, how things play out. And, we're very, very focused on making sure our people and their families are safe and sound. And at the moment, that's our primary focus in that part of the world.
Do you think there is a bit of an existential cloud over Dubai as a financial center now?
Well, I do think safety and security, matters. And I wouldn't say, I think it's a little bit premature to talk about existential clouds. But, if you're living and operating in a place and you didn't anticipate this, it's quite scary and it's quite unsettling. And so, as I said, our primary focus is on the safety and security of our people there. And we're working very hard to make sure that we're protecting them and their families.
What are we not talking about enough? I know we've talked a little bit about private credit. You don't think it's sort of a systemic risk at this point?
I think credit formation around the world is really correlated to, economic growth and economic activity. I do think that we've gone, if I just look at the U.S. market, which is obviously, when you talk about private credit, a very, very large market in the context of private credit, we've gone a long time without a credit cycle. We've gone a long time without a recession. I do think when you have these long-dated cycles, there are a variety of things that happen. One, credit spreads narrow. Two, lending standards, people have more capital to deploy, they get aggressive. Lending standards deteriorate a little bit, due diligence standards deteriorate. And so we're watching very closely to see if there's been a little bit too much aggression, frothiness in those markets. But fundamentally, when you look at the underlying credit portfolios, particularly below investment grade credit, while there have been a bunch of idiosyncratic events where there have been problems, the broad portfolios are performing reasonably well. Why are they performing reasonably well? Because the economy is doing fine. And it's very hard to have broad underperformance in a broad diversified credit portfolio if the economy is doing well. When we do have a slowdown in the economy, you will see it. I think because of the length of the cycle, you probably will find places where the losses are higher than people expect. We're very, very focused on back leverage and things that could affect or amplify in a more difficult economic environment, credit deployment. But at the moment, when you look broadly across portfolios, we're not seeing things that are super concerning.
That is the Goldman Sachs chairman and CEO David Solomon speaking exclusively to Bloomberg here in Sydney. Well, JP Morgan's head of Asia economics told us yesterday that the conflict in Iran represents a modest macroeconomic shock that is unlikely to derail global expansion. With the duration of military operations still the major uncertainty, we asked Sajid Chinoy whether India's economy is looking vulnerable.
India's current account deficit, a sustainable level, is considered about 2.5% of GDP. We're going to end this year at below 1% of GDP, number one. Number two, India's inflation is at 2%. And most of all, there's a huge stockpile of foreign exchange reserves. So I think the broader issue is after 2013, emerging markets have been working systematically to improve macro frameworks precisely because we're in this shock-prone environment where one shock hasn't abated and another one's upon us.
Let's take a look at how Indian markets are tracking at the moment. We are seeing a pretty decent rebound here. The Sensex better by 0.5%. The Nifty Bank Index a bit more subdued and not quite the same rebound that we're seeing in some of the other major markets in the Asia Pacific. But the numbers are green nonetheless. But take a look at the rupee, still very weak, and it did hit a record low yesterday. Now, on that note, I want to get more on the outlook for India's markets with Aditya Suresh, head of India Equity Research at Macquarie Capital. And Aditya, thank you so much for joining us. I just want to pick up on the remarks that were being made a moment ago there. We've got a situation where the oil price is rising, the rupee is very weak. What are the implications for India's economy, growth, inflation, and Indian equities as well?
No, thank you for having me on the show. Clearly, the Iran situation has a meaningful impact in terms of the macroeconomic backdrop for India. We are big importers of oil. We're big importers of gas. There are implications here to think about on inflation, the rupee, the fiscal deficit. So it's a meaningful event. And obviously, we are all thinking about the duration of this impact as well. But just purely from a markets perspective, I think the main theme, which at least I think about a lot, is the impact then on foreign flows into India's market. If I zoom out, think the story back, say, 12, 18 months, we, at least at Macquarie, were negative on India as an equity market, and a lot of it was down to how foreigners may respond to the high valuations and the lack of kind of earnings growth premium. We are starting to find ourselves a little bit more optimistic at the start of this year, and that thesis is being tested as we speak. And so I think if I think about this as foreigners are going to be the marginal driver of performance for India as a market, that's been tested.
So if you see this theme of underperformance starting to abate in the coming months, and the rupee is very weak, can you anticipate those foreign flows starting to turn around?
So one of the key, just to contextualize, so foreigners were net sellers of about $20 billion last year. We still saw strong domestic liquidity. So as an offset, domestic liquidity was strong. And so India as a market still we saw some absolute performance last year. In relative terms, there was still meaningful underperformance, and then that underperformance was amplified by the weakness in the rupee. Now, one of the key points which we were kind of making, at least at the start of the year, was that if I zoom in and think about the next, say 6 months, the broader dynamic was that we did think that foreigners come back to India as a market with the expectation that foreign ownership of the equity market was basically at levels not seen since 2010. And we thought that the thawing of this India-US relationships, the broader theme of kind of emerging market flows, wouldn't that kind of India see some inflows? Plus also just diversification. So when you think about India's beta, if I may, as a market, to whether it be technology as a theme or the US, it's been about 0.3, 0.4 since 2020. So a combination of those factors at least made us think that the foreign selling is going to stop. Maybe we see a little bit of buying. But Paul, really the story for India is going to be about if we are going to be seeing far more sustained foreign buying over the next, say 1-2 years. For that, the key challenge is that our earnings growth premium has got to come back. Historically, we've kind of defended the market multiple, which has been high, with a strong EPS growth outlook, about 500 basis points above the emerging market kind of outlook. At a point in time today, what we're seeing is that spot earnings in India has been weak. There's been consensus downgrades which have kind of come through. And so what we're looking at is India as a market, our growth relative to EM is, let's say, a 500 basis points discount compared to that being at a premium historically. But the market multiple remains elevated. So this earnings growth picture has to change. And that's both India starting to deliver on earnings and also some of the other parts of EM, which is a bit more cyclical, starting to cool. So that's more of a, let's say, 1 to 2 year kind of theme. More short term, it's more about the comments about the US relationships, diversification flows, these type of aspects.
You mentioned domestic buying a minute ago. I'm wondering if you could tell us a little bit more about that, because in the 3 sessions through to Wednesday, we still saw very strong domestic buying. It's now crossed $3 billion. There's a lot of activity from mutual funds as well. Where's this strength coming from, and do you see it persisting?
So this has been the key kind of support factor here for India as a market for the past 5 years, right? The bigger, broader dynamic has been just about the financialization of savings, the widening participation of markets and market participants. That's kind of been one theme, but when you kind of put this in the context of household savings, it's still small, but the cumulative impact of this is having a it's fairly profound in terms of flows to markets. But beyond the kind of like the SIP numbers which you see, there's also the other 2 themes which are about even the formalization of the economy with more kind of people coming into the pension scheme. That's having this impact of, one is there's more formalization, there's more participants in the pension pool, plus that salary pool is naturally inflating, and that's been allocated to markets. The other theme is on insurance, right? So like when the LIC is collecting these premiums and allocating to markets, that's been another factor as well. So when you think about 2025, 2024, the flow domestic into equity markets was about $80 to $90 billion. Foreign selling last year was at 20, and then the primary activity and supply was about 50. So you're still in a kind of, let's say, surplus, if I may, which is holding up markets in absolute terms. And really, this is the key theme for India, right? Which is that the financialization of savings of a low base, and that persisting, and the resilience of this theme has continued to kind of positively surprise.
Now, you were also overweight large cap private banks, and I know you're not alone in your enthusiasm for that story, but has the margin story now peaked, do you feel? Do you still retain that call?
So, in general, from a broader kind of top-down kind of perspective, we are kind of positive on the financials. We are positive in the material sector as well, those two sectors. But just to contextualize, the call we're making is not about forward expectations being revised upward. It's more about meeting growth and meeting earnings growth. So in that context, so for some of the larger kind of private sector banks, at least our view is that one is there is going to be a bit of an uplift in the pace of deposit growth. There's going to be a pickup in credit growth as well. At least our team, our financials team, is positive for the banks in terms of some margin expansion, not meaningful. The bigger lever still is about credit growth coming back to this, let's say, 13 to 15% kind of run rate, which had been soft. So for us, the bigger lever is still about credit growth rather than it being margin, but we are still positive on margins for the larger private banks.
I'd be interested in getting your views also on the reorganization of supply chains that we've seen going on as well, and whether there's an opportunity here for some Indian sectors to benefit. I mean, I'll give you the example of Indian sugar stocks, which rallied yesterday, and I'm like, yeah, sure, it's small, but are there other sectors, including this one, that could benefit from some of the changes we're seeing?
It's still small in the context of, it's a large theme, but it's still small and it's starting off a low base, right? So when you think about the exports theme in itself for India, exports to GDP is about 10%. So when you're going to compare that in a, let's say, emerging markets context, that still would rank India more at the bottom end of that graph. So it's still an emerging story. Areas like electronics manufacturing has been a key area of focus. You do have a bunch of pharmaceutical companies as well, which are trying to kind of expand their share of global trade. The autos is another sector, and autos, again, this is more about some large MNCs maybe using India as a base to then export to markets like Latin America, Africa, Southeast Asia, these type of things. But it's an emerging theme still. So manufacturing and the entire kind of export renaissance, if I may, for India, that's been a theme, work in progress for the past, say, 50 years. The challenge historically for India has been the lack of logistics. There's been friction there. At the margin, India is kind of trying to make progress towards reducing that bottleneck. They're also kind of giving incentives. But yeah, the broader theme of it being an opportunity for India is real. I think it's a slow ship to turn around, though. This has been a work in progress for some time.
Just before we let you go, I wonder if you can unpack something else for us. High-end luxury's been booming, but we've seen sort of mass market consumption in India looking pretty sluggish at the moment. When you run your eye over the India growth story, where's the real action happening right now?
So I think, Paul, to your point, it is still a bit of a mixed bag. We do see a note and see that kind of wealth effect, that the K at play in India as well. In terms of the, let's say, the middle class consumer, when you look at the RBI's consumer confidence surveys, which is done systematically, whether they be urban or rural kind of households, it's still soft, it's still anemic in terms of their of household expectations of whether it be employment conditions, jobs, etc. Even when you look at the hiring intentions and activity from some of these kind of surveys, it's still anemic in the services sector, whether it be IT, financials. And so the real challenge, I guess, for that middle class cohort has been this theme, which has kind of been prevalent fairly widely, which is about real wage growth really not keeping pace, right? And so you're not seeing income growth strong enough to as an offset for inflation. At the margin, we are seeing some evidence and to suggest that rural oriented kind of consumer companies are doing a little bit better. This shows up in data, for example, in two-wheeler sales, tractor sales, A lot of the consumer companies will speak a little bit more optimistically about rural as a cohort. I do think that there is a bit of a gold and a wealth effect going on in that comment as well. But it's not all pointing in the same direction. I think you have green shoots in rural. I think the top end is still okay. The middle class, I think there is an ongoing issue for us to think about that ties back to jobs and incomes.
All right, Aditya, Suresh, Head of India Equity Research at Macquarie Capital, thank you so much for joining us today. Still to come, China to keep fiscal stimulus flowing as domestic challenges stalk the economy with geopolitical risks on the rise. We're back live to the National People's Congress next. This is Bloomberg. Welcome back. You're watching Insight. China has set its least ambitious growth target of more than 3 decades in a tacit acknowledgement that the model powering the country's rapid rise is showing strain. Let's get over now to Beijing and our Chief North Asia correspondent, Stephen Engle, for more on the government's annual work report. Steve, what are the key takeaways?
Well, this was expected that they were going to ratchet down the expectations or the growth target for this year. And they did. And they made it a range as well. Instead of around 5%, which, by the way, they met last year. That was last year's target. This time it's 4.5% to 5%. That gives them wiggle room to basically absorb some of the external and internal shocks as they internally work towards a more balanced economy, relying more on domestic consumption. That's going to take more time. And also, of course, there's no, resolution to the ongoing property crisis. So there are internal stresses. No doubt, as we've been talking all week, about the external shocks, and that is something Li Qiang did talk about as well. He said we need to be clear-eyed about difficulties and challenges, adding that multilateralism and free trade are under severe threat. And also there was a story coming out of this as well, is that China is going to be halting, or at least or asking its refiners to halt exports of diesel and crude, I believe, at a time when the arrivals from the Middle East are under threat as well because of the shipping lanes through the Strait of Hormuz. So there's a number of different story angles here, but the key one right now is that China is going to be ratcheting down their expectations and their goal this year and also over the next 5 years as they basically codify the 15th five-year plan, saying that they're going to have a reasonable level of growth through 2030. But this is what Premier Li Qiang had to say today about the growth target.
The main targets for development this year are as follows. GDP growth of 4.5 to 5%, while striving for better in practice. Surveyed urban unemployment rate of around 5.5%. Over 12 million new urban jobs. CPI increase of around 2%.
So again, lowering that growth target, it is the lowest, actually, if you look at 4.5, the lowest that they've stated for annual growth target since 1991. That's when China embarked on that disinvestment of heavy industry in places like the Northeast, and there was a lot of unemployment and the like. So again, China's runaway growth has been, challenged, if you will, the last couple of years. So we'll have to see going forward about what this means for stimulus. Our read essentially is that it lessens the pressure on rolling out any widespread or sweeping easing or stimulus, and that they're going to accept a lower pace of growth in this new reality of internal and external challenges.
Well, the MPC's not done yet, about a week to go. What more can we expect to hear?
Well, we're going to get a press conference tomorrow, likely of the key economic leaders. That's the central bank governor, Pan Gongsheng, also the finance minister, the commerce minister, the head of the top planning body, the National Development and Reform Commission, NDRC, as well as the securities regulator, as we got last year as well. And then on Sunday, we're going to have a press conference on diplomacy, which that likely means it's going to be the foreign minister, Wang Yi, where we'll get more insight into how Beijing is viewing what is happening in the Middle East. He has already called those strikes by the U.S. and Israel on Tehran as unacceptable, among many different adjectives of how he describes what is going on in the Middle East.
All right, Bloomberg's chief North Asia correspondent Stephen Engle trying to keep warm there in Beijing. Before we go, here's a look at tomorrow's show. We're going to be live from Bangkok at the IMF Asia in 2050 conference. We'll be speaking exclusively with the Philippine and Sri Lankan central bank governors, as well as the IMF head Kristalina Georgieva. Plus the outlook for the AI trade with CEO of South Korean chipmaker Rebellions. That is it for Insight. Horizons Middle East and Africa up next. This is Bloomberg.